Good morning, everyone, and thank you for joining us today for this live China webinar. We've decided to shift things around a bit today. We're going to be doing, instead of doing a normal update with Liang and Tian, we're going to do a bit more of a Q&A. We've asked a couple of clients to send us their most prominent questions that they get asked about China. So I'll be facilitating the questions with Liang and Tian. So Liang and Tian has joined us from Shanghai, currently in lockdown. They're sitting in their houses there. I'm in our Stellenbosch office. Yeah, I hope today's session is of value and that you enjoy it. Liang, maybe we can start off with what's it like on the ground now? How are you handling lockdown? How is the team doing? Any effect on the economy, on the funds?
Sure, Davi. I mean, that's a fantastic question. Wow, what can I say? I think at around the 20th of March in Shanghai, we started seeing a slow uptick in cases in COVID. So they started to find a few cases. People are rocking up at hospital with COVID. I think in the early phase, certainly the local Shanghainese government, I think, was caught they had so much success in the last 3 years of doing contact tracing. I think they were kind of in a little bit of denial that the cases were climbing quite quickly with Omicron. So in the beginning, they didn't do much. And then at around the 20th of March, all of a sudden they said, hey, let's get everyone tested because, this Omicron case started to pop up in different hospitals across all around Shanghai. So all of us got into testing around the 20th and the 21st of March. And obviously it was 20 million people, took a quite a long while for everyone to be tested. Different areas got tested at different times. And then they got the results. And obviously the results were really, really not good. So on about, I think the 26th or 27th of March, with 4 hours to go till midnight, they announced that the east side of the city, so Pudong area, east side, 5 million people will be locked down from the next day. And then on the west side of the city, the second half of the city will be locked down 4 days later. You can imagine with 4 hours to go, everyone went out and tried to buy stuff, right? So now you're having a mass congregation event with everyone. They then lock up everyone in Pudong. After that's happened, everyone stay home, you're going to lockdown, and then they start mass testing the 5 million people. At the same time, people on the west side of the city, now remember, the city is not sealed off in any way. There's plenty of tunnels, bridges, everything prior to the 27th. So people will just go left and right. We'll work on one side and live on the other side. So now we know we've got 4 days left to lockdown. So what does everyone do? Everyone goes out for a last hurrah, try to buy everything, go to everywhere, try to grab all sorts of stuff. So once again, create another mass event. So then lockdown occurs 1st of April for both sides of the city. The data starts coming out, and now what's going on? You get this massive spike in cases. So cases have just gone absolutely through the roof. And then after that, they've realized that, okay, nothing more that can be done. Government still insist on COVID zero policy. COVID zero doesn't mean 0 cases. It means they're going to try to get the COVID level all the way down, that they do, to keep it very controllable and not spreading in the population anymore. And unfortunately, that means a very, very long lockdown. So the entire team and I has been locked at home for, I'm the luckier one, 11 days. If you're on the Pudong side of the city, you've been locked down for 2 weeks already. There is no end in sight. I think for the first time yesterday, the cases are coming slightly lower. As you can imagine, once you get locked down, it takes 3 to 10 days before the cases are there. You're testing 30 million people, so we're finding all these cases all the time. So that's what it is like in Shanghai. I think our best guess is lockdown's going to start ending probably towards either early May or mid-May to be a realistic chance of getting the city back to normal. I think it's such a shame that if on day one we just decided we're going to do a 14-day lockdown, not that we said 21st of March, we'll probably be fine. Unfortunately, we had all these, trying different things of not locking down the city, and now there's just a ton of cases. I think if you look at that and you look at the economies, it's very, very clear the economy is going to take a hit. I mean, geez, Shanghai is the biggest city in all of China. Shenzhen has just gone through a 2-week lockdown. Shanghai is in full lockdown with no end in sight for at least another 2 to 3 weeks. And Jiling's also having problems. So without a doubt, we're going to see the economy getting worse going from right now due to the lockdown. But at the same time, government we're ready with stimulus. They already cut taxes, cut VAT. So we're likely to see stimulus policies coming out over the next few months to counter that. So that's a very, very quick update on what's going on in China. Tian, do you want to tell people what a little bit of day-to-day life?
Man, I think I'll sound a lot more frustrated than Liang, but I've got some photos to show everyone. Yeah, so this is, we've been, as Liang said, we've been locked down at home in our compounds for quite a while. This is a photo of community testing. So every second day, actually we get tested every day. Every second day is a PCR test. There's also home test kits. So that's a photo of a typical compound where people come downstairs, doctors come to your complex, get tested. This is a map of almost a month ago now of the number of cases in Shanghai. So it seems like, it seems like something that's impossible to contain, and at least in my view. But the government's very, very sort of strict on the COVID zero policy, and which is why we don't really have a clear end in sight of this COVID zero policy. And if some photos of our home test kits. This was my first home test kit. I think that I'm on my 10th one now. I'm not feeling as happy as my first test kit. And we actually saw something quite funny on Instagram the other day. Is one thing that's not a question you ask people living in Shanghai is, when is the lockdown going to be over? Nobody knows. It sort of reminds me of when SA locked down in 2020. I think initially we were told it was going to be a 2 to 3 week lockdown, and then got extended twice or 3 times, just with no end in sight. So we're kind of in that first phase of extensions right now. But otherwise, I think it's, as Liang mentioned, it's positive that the government's come out today with some sort of stimulus measures. Markets reacted quite strongly in the afternoon, and hopefully there's more measures to try and offset the economic loss from the lockdown. So that's it from my side on COVID.
Thanks, guys. I think I might have jumped the gun a bit there, but Tian, if you can give us a brief fund business update, and then we'll jump into the more difficult questions, Liang and Tian.
Sure.
As with as with any webinar, just bear with us in the technical difficulties. If Liang or Tian lags, they are at home. And if you have any questions that you want them to address, just post them on the Q&A function. I'll relay them through to the guys. The chat function, I think for now, just that's been disabled. Thanks, Tian.
Great. So quickly, before we run into the Q&A session, just a quick business update. I think everyone's very familiar with our flagship China Balanced and China Equity funds. They're doing fairly well on a relative basis. I'll cover that a little bit later. But in terms of the product, there's something that's been officially launched. Our qualifying investors only China Gear Fund. Gear stands for Growth Enhanced Absolute Return. So that's essentially an extension of our China Balance strategy, but with a lot of use of derivatives to smooth out the return profile. So if you would be interested in something like that, we'd be more than happy to share further detail on an individual basis with qualifying investors. In terms of performance, equity, we continue to perform strongly on a relative basis. So over the quarter, we've outperformed the index by 80 basis points, and over the trailing 12 months, we've outperformed by almost 4% after fees. So we're quite happy with the relative performance, even though overall markets are down. Although mainland China not as down as China offshore. If we look at the China Balanced, we're very pleased with the relative performance there as well. Over the quarter, outperforming by 3.2% after fees. So very pleased with that. Over the past trailing 12 months, we've also outperformed by around 3.7% after fees. So quite positive, outperforming the 65-35 composite reference benchmark. So in terms of CPI, we're underperforming because markets are experiencing a downturn, but we're still managing over the past trailing 12 months to be relatively flat. And we're quite positive on our current positioning, especially with expected stimulus, etc., coming through. So I think that's it in terms of a quick update. And then I think probably we can head into the Q&A session. Bobby?
Thanks, Tian. Just GEAR, can you just repeat what does GEAR stand for in that fund name?
GEAR stands for Growth Enhanced Absolute Return.
Thanks, Tian. And then, you briefly updated us on COVID now at the beginning. It's a lot of cases, but how many deaths are there actually related to all these cases you're experiencing now?
Currently very low. So far, I think only 1 or 2 deaths. But we are very early in this wave. So I think we can't use that, and we can't say anything for certain right now, simply because we're very early in this wave. And what we're seeing is a conversion of asymptomatic people to becoming symptomatic. That's been happening. So more and more symptomatic cases are coming out and asymptomatic people converting to be symptomatic. So hopefully with the death will remain extremely low. So I think that's a good thing. That sort of lockdown, not letting it spread to, Shanghai is 26 million people. So I think cumulative cases is only about 260,000 so far. And I think with extensive testing, we should be getting close to capturing everyone who are positive. So there's not that much out there in the wild, because as mentioned, every single day we are testing.
Thanks. Okay, let's jump into this. Liang, maybe one for you first. On the 15th of March, JP Morgan came out with a research report saying China is uninvestable and downgraded the entire US listed China tech ADR to underweight. Is China uninvestable? Can you invest in a country where the government, with the stroke of a pen, wipe out billions of dollars?
I think, Davi, you're absolutely right. I think when it comes to China, sometimes we've always seen it. I mean, we've been in China for over almost a decade now, literally investing in China, living in China. And when it comes to China, I think we always find people swing either to be massively positive or massively negative. And the last 10 years, we've seen, almost more than 3 times where China has become uninvestable. So when we started the fund, I think in 2013, people said it was uninvestable because China's, the people are getting old, people are going to, we're going to go broke, before we get rich. There's too much debt in China, growth is slowing down, and that turned out not to be the case. So that turned out to be just, China was able to deal with that quite well, go up the value chain, and in spite of growth slowing down, returns were very healthy. Going on from there, in 2015, we had a financial crisis. A lot of leverage in the financial sector, a little bit too much stimulus, property went a little bit too hot. And from there, when that crashed, people also, wow, is it uninvestable? Is it the Wild West out there? And once again, it wasn't the case. It was, if you invested in those times, you made a lot of returns. In 2022, we are in the same space again. And I think that's actually quite exciting for us. So for us, I think if you look at the China tech sector, for the past 18 months or 24 months, we thought that sector was uninvestable. It was just too hot, too much good news, price to perfection, business model issues. And I think right now action speaks louder than words. And literally the day they said it was uninvestable was the day we were buying. So we started to buy, and we're starting to buy materially in our fund. But even now, we're still always well diversified. We're risk controlled. We use derivative structures to limit our downside while getting the upside to the sector. But I think sentiment is driving the uninvestable core rather than fundamentals on the ground. And especially in this quarter this year, the new fundamentals on the ground has not changed much, especially for the tech sector.
Thanks for that, Liang. I think topical now, Tian, one for you, very topical now. The Russian-Ukrainian war broke out on the 24th of February. The Western world has unanimously condemned and sanctioned Russia, but China has not. Why have China not done so? Do they support Russia in this war?
Oh, thanks, Davi. I think definitely the Russia-Ukraine war has been very topical. And traditional media headlines have covered actually China quite a bit in this situation. I actually have a couple of slides that I can share. So I think, first of all, I think what's quite important to understand is that in addition to conventional media coverage, we've seen that media reports that China and Russia, obviously officially that is also true, entering a new era of cooperation with no limits in inverted commas. So China and Russia definitely have great relations. But what media fails to cover historically and now is that China and Ukraine also have very positive foreign relations. So effectively, I think China and Ukraine and China and Russia the sort of triangular relationship. China is in quite a difficult position politically because both they have good relations with. China continues to trade with both Russia and Ukraine. Officially, China has taken a neutral stance. They don't want to take sides, not on the West or Russia. So what we've seen is a lot of media noise. There's been a lot of speculation of what China is going to do, but we see China eventually needing to act as a key mediator to help end this conflict. So in terms of why we believe China won't sort of join Russia in this war operation is that what some clear signs. For example, the Chinese ambassador to the US a couple of weeks ago engaging very closely with the US Commerce Department to try and understand the details of the US sanctions on Russia. So for example, what can be exported from China to Russia in terms of civilian goods. And then obviously with that, the US last week, I think, released some detail on value of goods. So for example, now goods that are produced in China with 25% or more of its value coming from US technology or US components are then affected by the sanctions. Otherwise, we think China needs to definitely also account for its domestic market interests. So not being part of taking sides in either the Western or Russian camp, continue to trade normally has helped to minimize domestic marketing impact, especially in terms of commodities, even though petrol prices have gone up, given the oil price surge. It's definitely fared better than, for example, EU counterparts. So overall, China's stance continues to be intentionally neutral. They are in a difficult position politically, but China we expect China to continue to find that fine balance between sort of balancing the relationship with the US and the EU, with Russia and Ukraine, and maintaining stability in the markets.
Okay, thanks for that. Specifically, the funds, has the war in any way affected our funds?
In terms of impact on our funds, it's actually been minimal. So direct market impact from the Russia-Ukrainian war in our funds actually absolutely minimal. The only thing that we saw on the 24th of February that was somewhat significant in the market was a sharp appreciation of the Chinese yuan on the day the Russian troops went into Ukraine. So that's probably a positive sign in our view, as that typically in times of uncertainty, you normally see risk-off situations for emerging markets. So it's the fact that flows went into Chinese yuan, capital flows came into China in times of uncertainty is showing that at least certain parts of the capital market sees China as sort of a less risky market in times of uncertainty. So that helps us gives us a sort of positive indication on the Chinese market sort of developing towards sort of a really super emerging market type of status, if we can call it that.
I think just adding to what Tian said, I think interestingly, for example, the limits of the sanctions has also kind of triggered a big increase in international trade of using RMB as a reserve currency. So I think we've certainly seen China testing out their CIPS system, which is far behind SWIFT in terms of market participants. So something like only 1,200 banks around the world versus SWIFT, which has like 20 or 30,000 banks in the world participating. But it just see an increased role played by the CNY. So I think our view on certainly in terms of market impact is that it's minimal, other than sentiment. So on sentiment side, it's a little bit negative. So China's quite far away. It's not in Europe. So to affect Europe the most, to affect the US and China the least. And China, with being a neutral stance, will continue its relationship with both Russia and Ukraine and the West, mostly on civilian goods, of course, not anything military. But in that case, I think the real impact on the Chinese economy is not much. And finally, I think, look, we do think Russia has made a terrible error in this. Russia's made a terrible error in terms of doing this invasion. But the reality is, regardless of how this ends, I think China will be one of the few allies of Russia, and Russia is a country with a lot of natural resources, and China is a country with a lot of natural, industrial base. So over the medium term also, we should see that China will have more influence on Russia, and that it should be beneficial for both sides in terms of trade.
Thanks, Liang and Tian. I think a follow-on question or obvious one is Taiwan. Maybe you can give us a feel of if China will follow suit. Will they do something similar? There's been a lot of questions around sort of the position on China and Taiwan.
Sure, I think definitely a lot of media reports on sort of comparing Taiwan to Ukraine, but very, very different situations in reality, and we'll cover some of the reasons. So firstly, I think if we look at practical differences, is that technically Ukraine is a sovereign nation recognized by the UN, the majority of the world. So Russia actually committed sort of an invasion, a technical invasion, legal invasion, however you want to define it, by invading a sovereign country. Russia calls it a special military operation, whereas Taiwan and mainland China technically are still at war, an extension of the Chinese Civil War, where a peace agreement was never signed. So mainland China and Taiwan technically still at war, although day-to-day sort of interactions between the two sides are very sort of normalized currently. So actually, if I move, I do have some content on Taiwan. So we do view Taiwan, the risk of mainland China invasion of Taiwan as being very, very low, although probability low, it would be a black swan event if it does happen. But the reason why we believe media sensationalize, if we look at this map, on this chart, we often hear media headlines of PLA aircraft. PLA stands for People's Liberation Army, which is essentially the mainland Chinese army. So we often hear news headlines of PLA aircraft entering into Taiwan's ADIZ. ADIZ stands for Air Defense Identification Zone. So effectively, it's airplane military exercises that supposedly breach some sort of air defense zone of Taiwan. But if you look at this defense zone, it's the rectangular shape sort of area on the map here, with the little island being Taiwan and the big landmass on the left being mainland China. So effectively, China can be sort of taking off from the airport on land and be sort of interfering with Taiwan's ADIZ. Although that's not always reported, this is typically what media sensationalist headlines refer to. If we look at the little red line here towards the bottom left of the ADIZ, that's typically where the PLA aircraft infringes on the ADIZ. So it's just an identification zone, it's not airspace, so it's nothing to worry about. And what we need to emphasize as well, these sort of military exercises have been happening pretty much on the daily, or at least every 2 days, at least for the past decade to 15 years. So this is nothing new. It's just that all of a sudden, given the Russia-Ukraine situation, media have picked up these reports and started reporting on it more. What is more to watch for is typically the midline between the island of Taiwan and mainland China. So if there's significant intrusions past the midline by either side, then it becomes more of a military risk. But we haven't seen a lot of that. Typically, heightened military exercises in the area are more related to US Navy presence in the South China Sea than Taiwan itself. So, and we haven't seen any changes to that. So that's the first thing. And then second thing is, in terms of why we believe the status quo will remain, is that Taiwan is not a security threat to China. So if we compare like to like, Ukraine to Taiwan, Ukraine, if they joined NATO, would have been a massive security threat to Russia, whereas Taiwan has no such plans to join any organization. Taiwan militarily, economically, is nothing close to being a threat to mainland China. So that's not something that's even close to Ukraine. Secondly, we believe that reunification with Taiwan is a matter of national pride and national priority for China. But in terms of practical priorities, this year, the government's very much focused on stabilizing the economy and sort of pursuing its common prosperity goals. Taiwan is not top on the agenda of the sort of CPC's to-do list for the near future. And what gives us probably the most comfort is the current TAIWAN DPP administration in Taiwan. They are very, very seasoned and experienced politicians. So what you'll see, I mean, politics is always sort of two sides. What you'll see is that both in Thai's 2016 and 2020 presidential election campaigns, they really pushed the anti-China and sort of pro-independence agendas to gather votes, because that is sort of the more popular political view inside the island of Taiwan. And they won by landslide victories. But we can see that both in terms of 2016 and 2020 election wins for the DPP, as soon as the administration comes into power, anything related to sort of formal independence declaration and formal sort of anti-China political moves that crosses any of China's red lines, it stops. So that's something very comforting for us. And also the fact that Tsai herself previously served as chair of Taiwan's Mainland Affairs Council. She understands all the sensitivities in dealing with China. So we're quite confident that the current administration won't sort of take any unwarranted risks politically. So I think the probability of anything in terms of military events taking place between Taiwan and mainland China, very, very low, at least until the next administration change from the 2024 election. So Taiwan, not really a sort of significant risk in terms of our view currently.
I think to add to what Tian just said, I think a lot of people misunderstand. I think they look at Russia, Ukraine, and then they extend that and say, oh, okay, well, it's China invading Taiwan. And I think Russia, Ukraine actually does the opposite. It contributes to more peace between China and Taiwan. And I'll explain why that is the case. War happens when two sides speak past each other, misunderstand each other, and misunderstand the importance of everything to everyone else. So between Russia, Ukraine, and the US and EU, Russia has continuously told them about the security concerns, and the US and EU ignored it. And the end result was war. And the scary thing is, over the past few years, I think China and the US had been speaking past each other. So China and the US are no longer communicating as well as they used to be, and they're speaking past each other. And after this war occurred, I think it becomes more clear to all parties. For the Chinese side, they understand that there is no military option in Taiwan. If you look at the support for Ukraine, the sanctions that will hurt a hell of a lot, China understands clearly there's no chance of a military invasion with a low cost. On the US side, the US also understands very, very clearly you cannot push past China's red lines, right? So if Russia would have invaded, if you push past their red line, then the threat of invasion is not a fake threat, it's a real thing. So US will be more careful and try not to trigger that to occur. And finally, on the Taiwan side, it's exactly the same. So prior to the invasion of Ukraine by Russia, 65% of the people in Taiwan believe that if something happens, the US will come to their aid. So that kind of gives them, makes them think, okay, if we declare independence, US will come help, but nothing will happen and it'll be fine. And that's one of China's red lines. Post the invasion, the same poll showed that less than 35% of the people believe the US will come to their aid. And that means that the independent voices in Taiwan is also likely to quieten down, that they themselves are not going to move towards that outcome. And absent that outcome, absent an official declaration of independence from Taiwan, it is almost impossible that China will invade, so war will not break out. So I think what's happened in Ukraine is highly, highly unfortunate. But it should contribute towards longer-term peace, or at least the status quo remaining exactly the same between China and Taiwan for the foreseeable future.
Thanks, guys. Tian, if I can maybe stay with you for a while. Perhaps just refresh our memories between China onshore, offshore shares. China, MSCI China has been down just over 30%, and then China Tech is down roughly 60%. The balance fund, I think, is down around 1.6% over the last year. So why is the fund so much different? What is the difference between between mainland China, MSCI China. If you can just go through that for us.
Absolutely. I think, yeah, this is something that we've been trying to communicate consistently to clients over the past probably 18 months to 2 years or so, is that there's a massive difference between China onshore and offshore, and that the difference is becoming bigger and bigger as time has gone by over the past couple of years. So I'll share my screen again quickly, just to show sort of a return difference. So over the past since 2018, so over the past sort of 3.5 years, initially up until, you can see from the chart, up until sort of beginning of 2020, the markets were fairly, the two indices were fairly close, even though not identical. You would probably say that they're highly correlated, generating similar amounts of returns. MSCI China has always been easier to access because you don't need a QFII license to access the domestic Chinese market. But since sort of 2020, 2021, we've seen a massive divergence in performance. And that is because of the concentration in MSCI. So in MSCI China, the top 10 makes up 40% of the index, and that entire top 10 is highly, highly concentrated in the tech and finance sectors. So mostly in the tech sector, and then with some of the largest finance companies. So it's a very, very concentrated index, and we expect this divergence in return to continue. So, I mean, you mentioned earlier, Davi, that MSCI China over the past 12 months, ending March 31st, I think return lost 33%. So lost a third of its value over the period, over the past 12 months. The Chinese tech sector, if we use the K-Web CraneShares China Internet ETF as an example, the most popular China ETF in the NASDAQ, I think it's lost 60% over the same period. So I think it comes back to sort of, in terms of our balance fund performance, if I go up back to our balance fund performance, is that you can see over the past year, we're only down 1.67% after fees. Firstly, I think it's that we pick CSI 300 mainland China, mainland China benchmark index. The CSI 300 top 10 only makes up about a quarter of the index. It is much more widespread, represents the economy, represents the overall market a lot better, much more diversified. And then secondly, I think a lot of the tech sector, I think we've also been saying that for more than a year now, that what we termed mania stocks, and many of the mania stocks that we looked at previously, so companies with PEs of 50 or above, that were still mega cap companies, really, really high valuations in the tech sector. And we've seen a massive correction. So just to give an idea, last year, we remember the education sector being hit with new regulations from the Chinese regulators. TAL Education, and New Oriental at the time, after a 90 to 95% drop in their share price, still were trading on PEs of around 15. So they were still trading on normal PEs after a 90% drop. That sort of gives you an idea of the excessive valuation in the sector. So I think in terms of markets, MSCI China, which represents China offshore, and CSI 300 that represents China onshore, they are becoming more and more different, and returns are starting to show that, and markets are starting to pick that up. We can see that it's the concentrated valuations in MSCI China. And then secondly, I think in terms of our China Balance Fund and how it's performed so well is our dynamic asset allocation. So we've been quite underweight equities, actually until mid-March, where we actually upped our equity exposure close to the bottom of the market. So I guess we don't always manage to do that, but our models have been working very well in terms of asset allocation. So we've been underweight equities on the way down, and currently we sort of have picked up some equity exposure during the month of March. And overall, we've performed very well relative to a 65-35 benchmark. So to summarize that, I'd say, firstly, our equity exposure comes from the diversified real China, we can call it. And then secondly, in terms of our asset allocation, we've been very active in managing that. hence the outperformance relative to the composite index.
Thanks, Tian. We've had some strong feedback from clients and their views about investing in China. So is buying Chinese companies supporting the Chinese government? And how certain are we or you that China is the next place to invest for the world or South African investor?
Oh, good question, Davi. I think to answer that, I think I always think, like, when I buy the S&P 500, I'm not supporting, US sending warplanes to Saudi Arabia to blow up kids in Yemen. So by buying US companies, I'm certainly not supporting US foreign policy. And I think in a similar manner, by buying Chinese stocks, you're not, all of a sudden pro-Chinese CCP. That's two completely very, very different things. I think to take it a step further, I think most investors around the world, you're already invested in China. So the world is extremely interconnected. So whether you're looking at Apple or Tesla or Nvidia or Johnson & Johnson or Samsung or Nestle or LVMH or Toyota or GM or even Naspers, I could go on and on and on. I would say at least half of the world's largest companies have China either as their biggest or their second biggest market. So kind of putting money into China is no different to what you already are doing. So that's already happening. And thirdly, I would say is that what people also don't realize is how much of a positive impact investing in Chinese companies has been for the Chinese people. And what I mean by that is, if you look at this time and time and time again, you can see the positive impact of having a global investor base. So if you look at Apple, for example, through global ESG pressure and through everything else, they come out with a huge, very, very strict supplier audit chain. Right, to have to ensure that all their suppliers, a lot of them in mainland China, employing millions of workers across the board in the country, have better access to dormitories, have better food, have paid a living wage, have good working conditions, and are taking labor laws into account. So I think the corporate sector certainly has been a very big positive overall in kind of just helping Chinese people and in terms of improving the lives of over 1 billion Chinese persons. So I would say since we joined the WTO in 2005, China has seen massive amounts of foreign investments in mainland China. And through out of all these investments, we've lifted 1 billion Chinese people out of poverty. I mean, that is a modern day miracle. I don't think in any other time in history has so many people been lifted out of poverty and into one of their best lives. And even as a South African company such as ourselves, who has operations in China, for example, often in the financial sector, we would be one of the few people representing South Africa. And through our feedback to the regulators, through the conversations to understanding investor needs, we've seen a consistently opening up of the financial services sector, as combined with a lot of other global asset managers, improving regulations, improving transparency, improving the investment environment for everyone. So we do think that, in short, overall, I think there's a lot of positives in terms of investing in Chinese companies. And as mentioned, everyone's in already. I mean, people are invested already. China is the second biggest capital market in the world. And over the past decade, I think time and time again, it has just shown how much of a good impact it has in investors' portfolios. Global investor flows into China has also increased exponentially over the past decade as the market opened up in both the currency market and the capital markets. So we do think that investing in China is a long-term trend. It has already happened and will continue to happen.
Thanks, Liang. I think you mentioned the positive impact on the Chinese people. Maybe the following is sort of the ESG theme. So if you can comment specifically on how you implement ESG in managing our funds. And I mean, is it a viable investment philosophy that can be properly applied in China?
Absolutely. I think there's no perfection. There's on doing better. So I think that's a starting point in ESG in China. So I think ESG investments historically in China has been nowhere. So people didn't do ESG investment in China. And over the last 5 years, because of global investment into China, ESG has become a bigger and bigger and bigger topic. And there's a few areas where we do ESG in China that matters to us. So number one is we make use of an ESG consultant, which helps us understand Chinese laws, what the Chinese laws say and who are breaking Chinese laws. And when it comes to all else equal, we will always underweight companies who are breaking environmental laws, governance principles, etc., when the other things are equal. So we're not an ESG manager. ESG is not our sole focus in terms of investing into China, but we do look at ESG things. The second thing we do is, of course, also look for warnings. So a lot of the ESG data, because companies are forced to reveal more and more and more, and that allows us to look at their governance, allows us to look at, wow, is there problems in there? And we have an ESG filter, which help us exclude some of the riskiest companies in China, and we'll exclude that from our investment process. So that's how we incorporate ESG into our investment process. Sorry, Davia, I think you're muted.
Property, we haven't really touched on property, Liang, so one for either of you to answer. Property prices are falling. Might this put Chinese growth at risk and cause financial instability?
Very good question. So I think the property sector is such an interesting one. So basically, the property prices have been slowed down in the last 3 years already. So this problem in the sector has been out for a very long time. Chinese banks essentially unloaded a lot of the debts, refused to kind of increase the debts. Chinese government came out with regulation to stop the growth of these companies. And essentially what's been happening, these companies, through either legally or illegally or ethically or unethically, raised a hell of a lot of money overseas, kind of dollar bond investments on overseas investor to put into this Chinese property sector. I think the latest data are twofold. So number one, the Chinese government is coming out to stabilize the sector, but stabilize the sector is not what you think. So stabilize the sector, they made very clear that number one, what they're doing is help property developers complete projects and give those so end users, people who's bought property, and make sure that they deliver these apartments to the people who's bought the property. But the Chinese government also came out and very clearly said, look, the sector is going to shrink. There's a wave of massive construction, especially in the residential housing sector, is pretty much over. I think on aggregate, Chinese people has gone from 2 square meters residential space to about 14 square meters. It's not a lot, but it is quite the norm when you compare to some place like Europe, where it's at, let's say, 20 per square meter per person. So I think inevitably this property sector is going to shrink and shrink a lot, and businesses have to also change the way they do business to take that into account. So from our side, we do think in terms of massive crashes, financial crisis, no, the government will bail that side out. But having said that, we do think that equities in the sector, the operation side will be very challenging in the sector. But having said that, look, all these companies are trading at a PE ratio of 1 to 3, so the risks are massively priced in, and it's all going to come down to execution and which companies are able to be nimble and change their business model to face a new reality of Chinese properties, which is going to be much slower growing. So historically, they've grown, let's say, at inflation plus 10 in terms of property prices, right? Faster than GDP, faster than that. Going forward, they're going to grow at inflation. So you've got to make these two, you've got to make an adjustment in your business model with those type of fundamentals.
Thanks, Liang. I think we're sort of getting towards the end of today's session. Maybe two more questions that's been coming through. You might have covered it, but maybe just so let's revisit this. Chinese regulatory stance affecting fundamentals. Does it actually affect it? Profitability, earnings of companies, etc.?
Definitely. So I think there's two things people have to realize. So number one, regulation is coming. And it's not just in China. If you look at what's happening in Europe, for example, Europe is going down a very similar path to China. So you've got anti-monopoly regulation coming. You've got all these labor practices and labor things coming, which is the exact same thing China has done. And also you're going to get, okay, well, not even talk about money laundering. Money laundering is always there. So it's something that every country will take care of. And also on top of that, the widespread use of AI algorithms and what they're allowed to do. do. So China, the latest one is that I think it's China's getting towards the end of the regulatory program. They've covered everything they want to cover, and all of those things in the short term is going to slow down these companies. So in the short term, it's going to have some regulatory fines. It's going to have some impact on these companies. So for example, the anti-monopoly thing. Historically, Alibaba and Tencent is invested in pretty much every single tech startup in the entire China industry. Now just think about how ridiculous that is, that two companies are essentially buying up every single promising tech startup, and simply because if you don't let them buy you, they don't give you access to their platform and you die. So the anti-competitive things coming out, every single new acquisition has to be approved now through a competition commission. So the rules like that will immediately slow down, and because of that happened, then all the startup valuation will have dropped, so the earnings will drop in the short term. So in the short term, we think certainly the earnings will drop. Number two, over the longer term, though, what happens? So two things happen. The first thing is, I think people are overly worried about the powers of these tech platforms. Chinese people are not going back. No one is going back. 1 billion people are on this platform. We love these services. We'll continue to use these services. So very, very soon is that their profitability will be clamped down the short term, but in the long term, they're still going to be there, and they're massively powerful businesses, very high quality businesses, and finally at a reasonable valuation. I would say they're not cheap yet. They're nowhere close to being cheap. Tencent is still very, very expensive, but they're at least reasonable. Whereas previously, it's pricing in, the moon. They had to win every battle and capture this market forever, ever, and make everyone's money. The second thing is the sector as a whole will grow. Because you have more and more participants in the sector. So I think the entire sector will grow, a lot more companies are going to come through, a lot more promising companies will come through, and it'll be a very interesting sector to be in over the longer term, rather than just having one or two companies dominating the entire sector. You'll have more competition, and that'll result in more longer term sustainable growth. So I think we're not as negative as a lot of people. So a lot of people, I think, this regulation has come out over the last 18 months, right? So what's really panicking people now is a price action. It's nothing more than that. You had 18 months to digest it. It's just a price action. And the price action also occurred because before this entire bubble burst, we had a situation where for the first time in the entire history, China capital market was opening up. So you had a situation where 1 billion or 100 million Chinese retail investors for the first time could buy these tech stocks. So you had both the foreign investors who always had high dreams about Chinese tech stocks because they think they're the same as the USA, and they're not. The US do not regulate. The US Congress is captured by corporates, whereas China is more balanced and more regulated, and so is Europe, in fact. So you got that coming in, you got this huge, massive pool of retail investors coming in, and that boosted these stocks to unsustainable levels. And now the opposite has happened. You had the US throwing the towels, all sorts of fear, sentiment, delistings, VIEs, all of these things are all distractions. They do not change the fundamentals, and that these companies have 1 billion users that we love using their services and continue to use these services. And because of the price action, people are afraid. So the sentiment is extremely poor. People are very, very afraid. And for us, if you're looking through, if you can stomach the volatility, look through the longer term, we think that the real returns in that sector will be quite attractive. Of course, take it with risk control. That is very, very important. It will be volatile. Sentiment is so poor at the moment. So why are we not maximum overweight in our balance fund? Because, well, sentiment is still very, very poor. We're starting to wait for sentiment to increase. And if you think about our philosophy, I think we're almost getting to the point where what type of markets do we like best? When do we like to invest the most into risk assets? When markets are cheap, when the fundamentals starts to improve, and at the same time, the sentiment starts to improve. So the markets are cheap. Fundamentals, yes, we're going through a bit of COVID. That's going to start turning around and have a rebound toward the second half of the year. And the last thing we have to wait for is just for sentiment to stabilize and start getting positive again. And that's it from me. Thanks, Darby.
Thank you, Tian. Thank you, Liang. I think that's that for today. If we didn't get to any of your questions, please feel free to contact your various BDMs in the regions, and we'll happily get back to you. If there is any, thanks for everyone for joining today's session. Liang, as you've always said, the best time to invest in China is when everyone is negative about it. So perhaps not the worst time to look at the fund, look at the offering. I think we've covered the major headwinds we normally face, or clients are asking us. So thanks a lot for your time. Have a great week, and we'll speak to you soon at our next, I think it's the income update coming up in a week or two. Thanks, everyone.
Thank you.